Well, there's another group of investors out there who are wealthier and more sophisticated than the man in the street. And by that I mean the pension funds, I mean the investment portfolios run by large banks, the wealth managers and so forth. I'm seeing more and more wealth managers tell me it's not a new fundamentals. We've had the situation for about 4 or 5 years where the mined supply of silver, if we talk about silver here, has been less than the industrial demand for silver. So industrial demand is consumption by the electronics industry, by the solar panel industry, by the automotive industry, and so on. Of course, there's a little bit of that going into investment demand. Now, that gap between consumption and mine supply has been rising, mainly because the mine supply is, it's not rising, it's fallen a little bit. I think it went up last year very slightly, but mine supply doesn't change very much from one year to the next for 2 reasons. First of all, most of the silver is a byproduct of other metals, and secondly, it takes perhaps 5 or 10 years to bring a silver mine on stream. So the mine production has been very static, well, in fact over the last decade falling, whilst every year the demand for silver for industrial use, particularly electronics, has been rising and rising fairly constantly. So we reached the point a few years ago where there was a crossover, demand exceeded supply, and the gap was met by what was in fact a huge quantity of above ground silver. You know, there's an awful lot of silver out there which has been waiting for donkey's years, for decades and decades, to get to its price, and as the price started to rise a little bit, a lot of it came on stream to fill the gap. But of course, as the price went higher, more and more sellers appeared, selling into that increased demand, and those who weren't selling were gradually becoming more and more reluctant to sell. In other words, they were the stick, you know, what they call the diamond hands, the ones who don't want to sell. So the first sellers are the paper hands, the weak holders. Gosh, it's gone up $5, I'm out of here. Whereas by the time it's up $20, the people who are sort of shrugging their shoulders and say, well, I wasn't selling it with $5, I'm not selling it with $20, and they're getting stickier. So we're now in a situation where we can clearly see that it's getting harder for consumers of silver, the industrial consumers, to be sure that the silver will be there when they need it. I mean, don't forget, they're running production lines where silver is probably a very, very tiny component of their cost. But if they don't have it, the entire production line for vehicles or solar panels or electronics comes to a halt. So they're really price insensitive when it comes to silver because it's such a small component of cost. So as we go into this situation of a rapidly rising silver price, and a lot of silver is starting to be taken off the market by now hoarders and investors, there's more buyers than sellers. So if you're an industrial consumer of silver, you need to be starting to worry whether you'll be able to get the silver when you need it. Will your production line come to a halt? So it's not a question of how much you pay for it, it's a question of whether you can get it. So I think we're part of the accelerated rise we're seeing now is every silver consumer saying, you know what, maybe there's a shortage, maybe there isn't, but I want to be sure, and they're rushing to market to get what they can just to be first in the queue.
For a time, existing silver inventories filled the growing supply gap. As prices edged higher, long-held metal re-entered the market. Early sellers exited quickly, but each price increase removed another layer of available supply. Over time, remaining holders became increasingly reluctant to sell. This phenomenon, often called sticky supply, reduces market liquidity just as demand accelerates. The result is a tightening market where available silver becomes harder to source even if total above-ground quantities still appear large. What matters now is not how much silver exists, but how much is actually for sale.
Do you think we'll also see a different market form where more players will step into the mining market directly? You know, take offtake agreements, for example, where they, have certainty of supply by buying silver now for the current price for a few years ahead?
I think it's quite likely that they're looking at those options. You can imagine that certain consumers will be talking to companies like Fresnillo, who mine in Mexico, to see if they can enter into some sort of agreement with them to take off their silver or a percentage of what they mine. This is in a certain sense, this is a kind of royalty agreement where you would give the mining company money so that they can mine more silver. In exchange for the agreement, they'll give you a percentage of whatever they mine. And that would be a way of, I'm going to say inverted commas, assuring the supply of silver. But it's not an absolute guarantee because you don't know what supply disruptions there might be out of the company or country from which you are getting that metal. So I think, if I'm a silver consumer in terms of manufacturing, I'd be looking at multiple sources and trying to strike deals with different companies in different locations.
For manufacturers, silver's price matters far less than its availability. In most industrial applications, silver represents a tiny fraction of total production costs. However, without it, entire supply chains can shut down. As uncertainty grows, industrial buyers are no longer asking what silver costs, they're asking whether they can secure it at all. This has triggered precautionary buying, with companies rushing to secure inventory before shortages appear. This behavior accelerates price movements and creates self-reinforcing demand pressure, especially in markets where delivery certainty is becoming more valuable than price stability.
Well, we have heard already that one solar panel company in China is, and I forget which metal it was, but they found an alternative to silver, and it seems to be viable at around the current price. So yes, I do think that there will be companies looking for alternatives, but I'm not enough of an expert to say at what price that will happen or to what extent it will happen. I mean, first of all, do bear in mind, it's not so easy to turn around your production from using one thing to another. Even in the motor car industry, changing from platinum to palladium or palladium to platinum is a very complex process. You have to completely rechange your machines and everything else. So it's not something which is done very lightly. But yes, at a certain point it can happen. And the old adage, what we all know is when the price is high, demand will go down, but we've got at the same time a rising price bringing in more and more investor demand. And of course, we've got geopolitical situations. I mean, with the whole debt situation, the global politics, the uncertainty about our money, I can only see that the number of people who want to have some sort of asset outside of the financial system, asset that they control, I don't think that's going to go down. I think that's on an upwards trend. I think it's going to stay. And that could overwhelm any declining demand from industrial users as they find alternatives.
To protect operations, industrial users are exploring long-term supply agreements directly with miners, including offtake and royalty-style arrangements. These deals offer partial protection, but cannot eliminate geopolitical or operational risks. Some firms are also researching substitutes for silver, particularly in solar and electronics. However, material substitution is costly, complex, and slow. Re-engineering production lines takes years, not months. While alternatives may emerge at extreme prices, silver's unique conductivity and reliability make replacement difficult. Any substitution would likely reduce demand gradually, not eliminate it.
Well, there's another group of investors out there who are wealthier and more sophisticated than the man in the street. And by that I mean the pension funds, I mean the investment portfolios run by large banks, the wealth managers and so forth. I'm seeing more and more wealth managers tell me that they took a bet on gold last year. And I know that's not 100% true. I think it's a fact that over the course of the year, some of them did start to put gold in the portfolios, and I suspect they regret that it wasn't enough. So what we're seeing from a public buying point of view, it's the wealthier classes who are saying, I'll buy gold because it's more of a traditional asset. It's less of a speculative asset. It's not an industrial asset like silver is. And that's finding its way into portfolios for geopolitical reasons. Mathematically, it can now be proven that if you had had gold in a portfolio for the last 4 or 5 or 6 years, doesn't really matter, it would have given you a better long-term return, and it would have given you less volatility. That volatility is where the price of the whole portfolio is fluctuating. That's translated it from an investment manager's point of view into something called the Sharpe ratio. That's kind of how they express it. But the real point is, you want to have better returns and you want to have less fluctuations in your portfolio. So any amount of gold in a portfolio would have done that. Now, having done the maths now, they can see that they should have had gold, which they didn't have gold. So what are they going to do going forwards? They're going to start, and some have started already last year, putting it into the portfolios, and we could well go back over time to the traditional amount which certainly Swiss banks used to have decades ago in their portfolios of 5% gold for every client. I think that's entirely possible. At the moment, we don't know exactly how much gold is in portfolios generally, but hearsay is it's less than 1% if you take all the portfolios and all the gold. I think that number is just going to go up. At the same time, we have heavy central bank buying. I think that what's most likely going on is central banks are allowing their government bonds, the treasuries that they own, and it doesn't matter whether they're European or US, they're allowing those bonds to mature as they reach maturity over the next 5, 10, 15 years. And instead of reinvesting it back into the same bonds, or maybe they're investing part of it back into the same type of bonds, I think letting part of it slip into gold. We're seeing that from a number of non-aligned countries, quite a few of them, who are adding gold to their portfolio in preference to adding treasuries. Now, I'm not saying that any countries planning to kick America in the teeth by saying, screw you, we're selling all your treasuries. That's not going to happen. That would be, that would be, well, you can imagine the perception if they were to do that. So I don't think that anyone's going to do that, but I think it's just a question of less will go into treasuries and more will go into gold going forwards, and that's actually what's happening. And obviously there's a certain fear that we've seen the weaponization of the dollar against some countries, and countries are now starting to say, well, we've been best friends with the USA. What happens if tomorrow we thought we were great friends and suddenly they're turning out to be a threat? Where is Greenland? So, Greenland thought they were great friends with the United States, and suddenly they're not. Well, they still are, but my point is this, that a lot of European countries are suddenly finding that there's all kinds of threats being made if they support Greenland. So how are countries going to start thinking when it comes to how much of their wealth, their sovereign wealth, should be in paper dollars, which can be printed ad infinitum? And if we go back to this suggestion that maybe every Greenlander should be paid $50,000 or $100,000, in paper money, well, if that were the case, you're being paid in paper money, which could be confiscated at the flick of a button. I'm not sure that's a very good offer. Now, they might look at it differently if they were being paid 1,000 ounces of gold per inhabitant, because then they could bury the gold somewhere in the ice and hope that nobody knows where it is.
Alongside silver's industrial squeeze, gold is regaining prominence in professional portfolios. Large asset managers and pension funds are reassessing gold's role after years of underallocation. Recent performance data shows that even modest gold exposure improves long-term returns while reducing volatility. This realization is driving renewed interest among institutional investors who historically favored gold as a stabilizing asset. Meanwhile, central banks, especially in non-aligned nations, are increasing gold holdings as they reduce reliance on government bonds. This shift reflects growing concerns over currency stability and financial sovereignty.
There's two types of printing here. One, you've got the central banks who could increase the physical money supply or the money supply in the banks, and of course the banks themselves would create money through the fractional reserve banking system. But the the biggest driver of all this is the generalized increase in government debt everywhere. And government debt has been increasing by 6 to 7% globally. Now, what that means is every year the government gets poorer because it borrows money. Someone gets that money, and when that someone gets the money, they try and decide what to do with it. So they might buy real estate, they might open a factory, they might buy equities, they might buy businesses, or they might buy gold and silver. Now, everybody who's getting that money, whoever, it doesn't really matter who they are, but collectively they're making decisions to put that money that they're getting from the government, obviously it's not coming to them directly, it's coming through the system, but they're the wealth creators. Collectively, they're making that decision to allocate the money they're receiving into a variety of things. And if one of those things is in relatively short supply, and although the above ground supply of gold is immense, most of it's very, very tightly locked up and not going to move, and it hasn't moved for centuries. So when they try to put it into something which is relatively small supply, and the supply of gold is actually only about 1% of new gold a year, it starts to squeeze the price upwards more than it squeezes up the price of something else which is in greater supply. So taking money and putting it into treasury bills or treasury bonds won't push up the price of treasury bonds because the market is too immense and too vast. But if you take the same amount of money and put it into the smaller equity market or the much, much smaller silver or gold market, it's going to move the price further.
The deeper force behind rising precious metal prices is global debt expansion. Governments worldwide continue to borrow at accelerating rates, injecting new money into the economy. That capital must flow somewhere, into assets, businesses, real estate, equities, or metals. When money enters large markets, prices barely move. But when it flows into relatively small markets like gold and silver, prices respond sharply. New gold supply grows by barely 1% annually, while silver supply remains constrained. As more capital seeks protection from debt dilution, limited supply assets naturally reprice higher.